this last month, I think people are getting more confident again that maybe we're done here on hikes, possibly one more.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, continuing on our coverage in the silver world, which, as we are now headed towards the back half of 2023, amazing. As the year has gone quickly by, we've seen a lot of volatility in the silver market, although, as we'll dig into today, we're recording on Tuesday, September 5th, and a little decline in silver. We're just about back to where we started the year. And to dig into this and some of the other recent economic news and where things might be headed from here, joined by my friend Steve Cope of Silver Viper. And Steve, great to have you back on this month. And how's everything going with you?
It's going well, Chris. Yeah, I mean it's I think been a better month than when we last chatted. Even though you said it's down a little bit today, I think we're definitely trending in the right direction.
Yeah, well, as we record again, this is on Tuesday afternoon here, and we see the price of silver down a bit below $24 on the futures chart and right about to where it started the year at $24. We've had banking issues mixed in. We've had the Fed stay higher for longer as they suggested they would. And Steve, I guess now that the summer is over, we'll see what happens with traders coming back to the desks and perhaps some more volume going forward. But before we dig into some of the other stuff, just any thoughts on what we've seen throughout 2023, which has left us even on the year? And what do you think about what we've seen so far?
It's definitely been a wild year. Like there was so much optimism in the space in January. Metals prices were going. We were supposed to be ending rate hikes. And people were getting really excited about gold and silver, and then as inflation didn't get under control by the government standards, they kind of had hinted then that rates were done and we would be looking at potential rate cuts by the end of the year. And instead we've had two or three different rate hikes at least since then. And it's kind of thrown the market into the loop, and people are sitting back and waiting and trying to figure out what's going on. So it's this last month, I think people are getting more confident again that maybe we're done here on hikes, possibly one more, I guess, but we'll see. And I think that's starting to give people some more confidence. And that's why, from the time we spoke last to now, I think we've seen prices rebound pretty nicely, both in gold and silver. And obviously we know it needs to go a lot higher, especially on the silver side. But I think there is optimism coming into the fall here, and we'll see. Every time Powell speaks, you never know what's going to come out of his mouth. But I think you are going to see an announcement fairly soon saying, definitively that, for a year we're not going to raise rates, and then I think that's the first step into them ultimately cutting rates.
Yeah, that makes a lot of sense. And certainly, whether we've seen the last hike or not, have not seen any of the Fed governors suggest that they're going beyond that extra hike, perhaps higher for longer, although we continue to hear central bankers. There was one out this morning. Here is Christopher Waller, and he's suggesting that, encouraged by recent reports on where prices are trending, also said that they indicate the Fed can afford to hold rates higher for longer. And as you and I were talking about before we hit the record button, obviously, I think when we get to the point where there are rate cuts, which I'm not sure, I think would require some banking issues to see this year, but still seems with where things are headed economically, a high probability of next year, which would certainly be a boost to the metals. But you were saying that you think even when they announce that they're just finally done hiking, that given how actively the market's been waiting for that point, that even that could provide a bit under the metals.
Yeah, I think that's the main thing. I mean, we kind of, again, if you go back, we saw it in January. They'd come out and said, "Yeah, we're pretty sure we're done raising rates," and the market reacted. We saw gold and silver run. I don't think we need to wait for rate cuts. I think obviously when we get to those first rate cuts, that's going to be another catalyst for the prices. But I think our first big run up here will be when they do come out and definitively say, "No, we're done. We're pausing." Whether that's for a year, 6 months, whatever they want to say, and then where the market can get some confidence that these rates aren't going to keep going up, you're going to see definitely a healthy rebound both in metals prices and in the equities.
Yeah, and as we take a look at the probabilities, we see 93% chance of a pause at the upcoming September meeting. Looking a little further out, we see still markets pricing in a possibility of that additional rate cut sometime between now and January, although the favorite is to stay at a pause. So we will see how that goes. One of the things that obviously the Fed will be looking at is labor reports, which it's interesting how each month these come out beating expectations. Last month was came out last week, beat expectations by 17,000. Although there's a trend here, Steve, that every month so far this year, we have on the announcement, it comes up above expectations, but continues to get revised lower, including in June, where we had an 80,000 downward revision, which had been lowered by 24,000 the previous month, which had taken it from 195,000 down to 105, 106,000. So seems like if you look past just the number that's released on the day of the release,
Yeah.
a lot of these numbers are showing that the employment market is slowing down too, which is obviously a big part.
Yeah, I mean, did they beat expectations in any of those months after the revisions? I would wager that they probably did not. So it's, again, we know, and we've talked about in the past, the way data is manipulated, for the purpose of the government in the U.S. especially, is crazy. But and I mean, then that's the way they calculate it. Then on top of that, you start worrying about, okay, well, some of these jobs are created because the same person's gone and got 3 part-time jobs, and they count as 3 people in the job market getting new jobs, but they were laid off of their, high-paying tech job. So the jobs that are out there aren't the jobs that people want and are after that pay very well. So again, it's just the number of jobs has always been a skewed data point for the health of the job market in the US. So I mean, yeah, I always take any data from the U.S. government with a grain of salt.
Yeah, I hear you. And here's another one that I've been looking at. This is the Purchasing Managers Index, which we can see has been getting lower over the past year. Anything under the 50 line is a contraction. We see, not a surprise, right around the time when interest rates started going up, you have contraction in that. Although balanced against all of this is something that perhaps is what is created not a perfect storm, unfortunate for living conditions, yet perhaps a boost for metals, because at the same time this is happening, we're now starting to get the higher oil prices again, which makes me wonder if there's going to be an issue. We've seen inflation numbers come down throughout the past year, but a lot of that was based on cheaper energy. Now we have higher oil prices. So again, leaves the Fed in a position where even with the numbers lower now, we see oil stay around here, probably have not seen, we've seen the inflation of the currency already, but the impact of that resulting in the higher prices probably is not over.
No, I mean, again, I keep my eye on oil too, because that's throughout this whole inflation process. That's the one thing that the government can kind of control, and they cut their deals with OPEC and decide, like, hey, we need to get those barrels down to show that these interest rates are bringing inflation down because of how large of a component the oil is in that. And yeah, I mean, I guess we're gonna have to watch that. If there is another rate hike, you're right, they're probably going to base it on the fact that inflation's gone up, and it's going to be because of that oil number. The only other side, like on the Canadian side, is housing, and that makes up a third of ours. And the second that they triggered that pause in January, it was a massive kick start for our housing market, which our government federally has been after, trying to keep it down forever. So both of those, I think, are very heavily watched to see, because they both affect inflation a lot. The idea that raising rate hikes and raising rates is stopping inflation, whereas the worst part of inflation for the average consumer is what their groceries have done and what the cost of living and everything else is doing. And these rate hikes don't stop that, and they never have. So we'll see how they manipulate the data. I mean, maybe they cut a deal in OPEC and start, flooding the market. The U.S. taps into the reserves again and floods the market with those to bring the price of fuel down, oil down, just to let us see that we're not in this inflationary environment that we all know we're in still. But they can't go much higher. I mean, like you said, they've had banks failing earlier in the year off rate hikes. They've got people feeling the crunch and struggling to get by. So you continue to raise rates, and you're coming to an election year, and they want to make people feel warm and fuzzy about their lifestyles and not be hurting when they go into an election and risk losing their spot as the government. So I'd be shocked if they continue to put the pressure on people and make people feel this pain here for the next year going into that. So we'll see. Maybe I'm wrong, but it really feels like they're going to announce a pause here, kind of no matter what, and just wait and see here. At least give it a year to see what all these rapid rate hikes are, how they're actually going to affect the economy, and not continue to just react in the short term before that can really take effect and do what it's supposed to do.
Yeah, I like the way you phrased that. It is going to be quite theatrical to see how we can get people feeling warm and fuzzy ahead of an election year. Of course, another indicator, we still see an inverted yield curve, which has just about a perfect track record of predicting a recession. So, unfortunately, not ideal conditions out there, which, whether one feels they should or not, usually just about every time in the past has resulted in more quantitative easing, more money printing, lower rates. Although, Steve, back to the oil picture, I'm curious, how have you seen any impact in that on the mining side? Obviously, mining, pretty capital intensive, energy intensive. Have you seen any any changes in the recent months, and perhaps even taking that back a year or so? What the costs have been looking like on the silver mining side?
I mean, we don't actually mine, so we don't have the fuel consumption that the producers obviously have in what we're doing. But that being said, you've seen it on the quarterly reports as these miners have been coming out with their costs, and you're seeing them all have rising costs across the board. They're all in sustaining costs, or the various different ways they're reporting their cash costs are coming in. They're all coming in higher. So you're definitely feeling the crunch of not just energy, but labor. Everything is going up, and we're seeing inflation heavily weigh on the miners. On our side, where we're using that predominantly is in drilling, and we definitely are seeing drillers come in with slightly higher quotes, but it's not anything overly material that's changing it. If we're going from 150 US all in a meter, it might be 160 a meter now, type of thing, with the way costs have gone up. But it's not really changing our budgeting or anything along that line, but it's definitely something that's going to get factored in when people look at projects. They're going to look at what type of energy, how much fuel consumption, how much is electricity, depending, however you're going to get your power ultimately for a mine, or for your, obviously your trucks and everything else that go into it. It's a cost that's rising, and you need to have, a better looking economics to make up for those rising costs.
Yeah, and it's created a tough environment for the mining stocks over the past year, as people are obviously well aware. And even a lot of stocks trading below where we saw when silver was back at $18, even a little below $18, just about a year ago today. And I'm curious, is this remind you of any other period that we've gone through in the past couple of decades in the mining that maybe people could look back to as a comparative example, just in terms of the current setup, where again we have these margins getting smaller, would seem to necessitate a higher price at some point? Won't even dig back into the growing green demand, but with all the factors going, running the deficit and the silver imbalance, is there another similar example in recent history that we can look back to that give some insight into how things might play out from here?
I mean, there's definitely periods where we're in these long, drawn out down periods. I mean, 2015 for me comes to mind really quickly. Like it was rough. Like there was no capital out there, even if people loved your projects. And then you came out of that in 2016 and started to get really good again. This has been a really bad year and a half. This last year and a half has been painful in our sector, even in a rising, and a lot of that having a rising metals prices. It's just, again, reverting back to what we talked about earlier and the crunch that people are feeling. There's just not a lot of disposable income out there, and people over the last year and a half have been slowly or quickly, depending on who it is, selling anything that's a paper asset. So even when you were in a pretty good metals environment price wise, you just had a steady outflow and people selling stock and not a lot of people able to buy it and take advantage of it. So, I relate to like the start of COVID when we've had that first big pullback in COVID. And then what are the first equities that rebound as you're coming out of something like that? Well, it was mining stocks, and companies were hitting all-time lows, and within a month or two, as it turned, we were at year, 2 year, 3 year highs on our share prices. So it's, when it does turn, it can turn very quickly. And these stocks right now, especially now with all a lot of these assets that have been de-risked and have been proven and are sitting there with a very healthy resource and good jurisdictions and everything going for it, and they're trading at close to all-time lows. It's a very good opportunity for people to place their bets, and even if you pick a bad company, it's gonna rise with all the other companies, and you're gonna do well in it. And then if you pick the best of the bunch, then you're really gonna do well. And I think that's what we're coming into. We just need some calm and some certainty for investors. We need money to start pouring back into the funds in our space that are the specialized, with the companies like us really go to for financing and the larger investments. And they've had outflows for a year plus. And again, not a lot of capital to be able to deploy back in, because they're constantly having to sell stock still to cover the money that's being pulled out of the fund. So it's been rough, and you haven't seen the miners overly step up yet and start financing the juniors. But they're normally in a bad market who the juniors rely on. You start seeing a lot more strategic investments, or just participating on JVs, different ways of getting access to these projects. And the miners haven't jumped all over that yet, because they're still sitting wondering what's going on, and they're enjoying the free capital that, especially on the gold side. The silver side, they've been struggling, so it makes sense that they've had a lot of free capital. But the gold companies have been doing really well financially. So again, we need some of that capital to start being deployed back into the space. I think we're getting close to the end of this, and it's just stuff is so cheap. It's, if you have one of these rebounds like you saw in the back end of 2015, on the back end of COVID, that first run in COVID lockdown when everything got smoked, going all the way back, you go to 2012 and coming off the high there, and everything went down, and then a few less than a year later, things were back up to all-time highs. So you get these pullbacks where it feels like the world's ending, and you got to survive as companies. But when you come out of these things, the amount of wealth that can be created very quickly if you are tied into some of these companies, it's pretty impressive. So it's just, people need to be patient. People, if they have and are interested, I think you're not going to get much cheaper than where you're at right now. So hopefully, I'll knock on wood when I say that, but I think it's a pretty good time to be looking at the junior market in our space and build pretty healthy positions in some very high quality companies.
Yeah, and are you surprised that we haven't seen more acquisitions with things on the low side? Obviously, you talked about how it's difficult for a lot of the major silver companies, happening a little bit on the gold side, but surprised we just haven't seen that yet. With, again, things at such a low end, seems like the time that you'd want to be picking up some of these assets cheaply. Any thoughts on that?
I think it should be happening. I just think, one, it takes two to tango in one of those transactions, and there's a lot of people that are so cheap right now that if someone does come knocking, they're saying like, I don't want to sell. They because they probably firmly believe what I just said, and that you could be a week, a month away from this rebounding and going up 4 or 5x just on the market rebounding, and saying, why would I sell now? And then look really foolish if the market turns. So you don't see a lot of hostile takeovers anymore, just the way that the exchange rules and everything work. It's pretty hard to go hostile and take someone over. So you need a party that's willing to, and I think the funds have told us that we should be doing that, that we need to be merging. They don't want single asset companies. They'd rather, three or four of their companies merge and become one on the exploration side and development side. And so, we have to be cognizant of that. But it's hard. It's hard when you're looking, when you're trading at, a share price that, probably is below what you listed the company at in a lot of cases. And it's hard for people to say, well, I should sell now after, especially if you've had a lot of success, you've built up a healthy resource, you've done everything right, and it's just been this market. It's tough. So I think you'll see it, and I think maybe there'll be a race as things start to rebound. Even so, I mean, I think if this continues for much longer, you have to see some acquisitions, because there's a lot of companies that have nothing left. Like, they're on absolute life support. So we'll monitor and we'll see, and we're, always looking. We almost did it with Canasil, but just weren't happy with what we found when we started doing our due diligence. But there's definitely an opportunity, like you say, if you can find those companies that are really struggling, to potentially, grab a couple of really good assets, or one or two good assets down here when prices are cheap, and again, make your company look that much stronger coming when we do come out of this bad market.
Yeah, that makes sense. Where obviously a lot of people, if they are able to still keep going and believe in their project, obviously not wanting to sell at this particular time. Also reminds me of something I was reading recently, which I'd love to get your comment on. This was an article from Rick Rule, or commenting on Rick Rule and some of his criteria for gold and silver stocks. Of course, the first one being the management team. Second, he talks about the size of the project. But interesting note that he had down here. Also, patience and courage are key components to success. Rick has said most of his 10 baggers required around 5 years and endured a 50% decline along the way. So I'm not saying this necessarily helps people feel better who have seen things go down over the past year, but perhaps more so than tech stocks or the regular stock market. Believe it or not, the types of moves that we've seen, perhaps even more exacerbated over the past year, yet still somewhat common for the mining industry, which, whether we like it or not, has been how this has historically gone.
Yeah, I mean, that's the I mean, Rick's obviously been a really good investor and has his model in our space and done phenomenal. And the best that I know is the guys at Ingalls and Snyder out of New York. And Bob there, I've presented to him lots and talking, and he's like, he takes massive positions, and he knows that the junior market, for the most part, even in a good market, is fairly illiquid. And so, the positions that they take, they're not going to be able to trade out of those positions. And he says, look, like, I only need one or two out of the 10 that I pick to work out, because they're going to be 10 baggers plus, and I make a lot of money, and everything else can go to zero for all I care. And he's been doing it, for longer than Rick's even been doing it in this industry, and made himself into personally into a billionaire, because he's been so good at picking these stocks and being patient. He never sells a share unless management does something that just absolutely offends him and pisses him off. But he knows he's not going to trade out the positions and the people that he represents there. And that's how you have to invest in this space. The junior mining space isn't meant to be J traded. You could goof around and do it a bit and try and trade in and out of positions and make your 10% if you can, but you're going to get burned on that. Ultimately, you're going to run into one of these periods when you're trying to make that trade and get stuck and fall down, and then you're going to sell out of it when you do get out, and then you're going to miss the run up. And that's not how you make money on the junior space. It's a high risk space, but it's because of those 10 baggers that Rick's referring to there, plus, and you get those by being patient. And really, you should be in these companies, for the long haul. And there are a couple of key exit points that people should look at, but normally it's around a takeover, and the premium you get on a takeover, because one of those big liquid companies takes you over and you can trade out of the position right away, or the arbs are locking in the transaction, and you've got lots of volume, you can trade out. That's where your exit points are. You can, or you could exit at discovery. If you get involved with these early and the company makes a new discovery, there's lots of news and hype around that. It's not a bad point to jump out at and make profit. But But to sit there and be impatient and be mad that something's down, a month after you invest in it, that's if that's the stress level and the focus that you have, you shouldn't be investing in the junior mining space. You have to take those long multi-year approaches and just know that you're go do your due diligence, do your homework, pick your 10 favorite companies and invest in them. And you only need, especially right now, probably one of those to do really well, and and the rest could go to zero and you'd make money. And that's your focus. And again, I think if you're doing it now, you're timing the market a lot better and not having to wait those years to hit those big wins, because we've been so down for so long that we're doing fine. But again, I just, it's a tough space, and you can have long down periods, but when you do get those longer, good markets, or really good markets, you make a lot of money in this space as an investor.
Yeah, I think that's well said because, like you point out, certainly silver, to some degree, gold as well, requires a bit more patience than a lot of other markets. And I think it's tough for people, especially when you see the NASDAQ soaring, to be able to sit in something for a couple of years rather than a couple of months or a couple of quarters, which I guess people can like or not like that that's the case, but at least understanding the dynamics of the industry and how it plays out, better to understand those and be aware of them and pass or not. But at least
Well,
having,
people get frustrated, right? People know, like, look at a 5 or 10 year gold chart. That's a really good looking chart. It's, if that's another sector and you're there thinking like, this is the sector chart, you think everything's running high. But because of just how our commodities are used and how people have focused on them, and they're your hedge, and they're, this, they act differently. And you get, like you say, into a market like this, and you would think your equities are doing really well because gold's performed pretty well. And yet, because it's a paper investment, and like I say, people went out because people are hurting, that's, you don't get the run up necessarily. It's actually on, like I say, the back end, when the market starts to recover, it's those equities that do really well. And it doesn't really matter what gold or silver at then. It's just, that's where the money flocks back into, because they're so cheap. And the ramp up and how fast they trade and go up is, it's exceptional. So it's just timing that market and sitting in there, being patient. Or if you have that capital, as these things go down, and continue to deploy it and build your position. If you can get in, if you get really lucky and start timing it and pick right at the bottom, then great. But we've been hurting for a long time, and you don't normally hurt this long in this sector before you have a really big rebound. So again, I think we're all anxiously waiting for that rebound to come. But I think the way things are shaping up out there, with what the Fed's going to be doing, with what the BRICS and what the challenge of the US dollar on that front is going to be coming more and more prominently into the media and people's attention coming forward, and what that could do to the dollar index. But right now it's the dollar index. The dollar is performing so well that, again, it's hard. You're not going to see gold and silver run on that. But and so we have to wait. You need all the stars to align, but I think it is coming very quickly.
well, and we'll certainly get a little more color on that in 2 weeks from time this one is broadcast. So Fed meeting only a little bit away. And Steve, before we wrap up, perhaps you could give us an update on any news that has come up in Silver Viper and how things are coming along with the project.
Yeah, again, we're gearing up for our drill program this fall. Again, we've been prepping and finding more and more targets that we think, have new discovery potential. We're vectoring in on exactly where we're going to be putting those drills with, the best chance of success, both in El Ruby and at El Molino to start with. But yeah, we want to grow on that maiden resource that we came out with on El Ruby, and expand that. Really want to see the next resource come in over the 1,000,000 ounce gold equivalent. We're sitting at about 700,000 ounces equivalent right now on the gold side, or 49 million ounces of silver on the equivalent side. So again, it's a great healthy start. It's a great project that's got very attractive economics when you compare it to the other open pit heap leach operations in the state of Sonora. We're double the average grade of what most of those are when you factor in our silver, but our gold grade in itself is already 50% higher than what the normal mine is in the state. So again, it's a great project. We've got a brand new power line corridor going through the project. We've got water year round. Where El Ruby sits is very appealing for open pit heap leach mining. It's on a flatter 2K by 2K plateau. So again, very favorable with gravity and how everything else would work on that for open pit heap leach mining. But then we've also got our high grade structures that we're going to be trying to prove up and get a maiden underground resource that would sit below that pit. So lots of things to come. Stay tuned. We're really excited about the project, and then like we talked about, we're constantly evaluating other companies and maybe looking to add, some really nice another attractive asset in there cheap if we come across the right one and can get it.
Yeah, and again, something you've mentioned before is that they actually had 180 drill holes between Pan American Silver and Mine Finders before you picked it up. Although what really caught your attention was the exploration potential you felt was possible there, which again, you guys are going to be continuing to move forward in the next couple of months. So we'll look forward to seeing how that goes as things develop, and just appreciate you making some time to check in. And at least the summer is over. We'll start getting the traders back, see where the next phase of the market is headed. Although I think, like you said, some patience can help a lot, especially if you can see the long term in these things and some of the dynamics at play. But either case, we'll look forward to catching up again next month and see where things stand then.
Sounds good, Chris. Thank you.